Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 4 o'clock in New York on Monday, 10th day of March 2014, and this is the daily report for gold and silver. Actually quite quiet in the marketplace today as we have gold up about 30 cents on the day, silver down about 6 cents on the day, 1339.62. It's had a high of 45.80 and a low of 28.50. Silver actually off about 6 cents on the day, the low 20.55, the high 21.16. We will talk about silver towards the end of the show. Traders, before we start our show today, I want to just very quickly talk about a new feature that we did integrate over the weekend into the system. This is thegoldforecast.com, obviously. Typically, when you hit our link to watch a video, it's taking you to the daily report. You know that you can see the most current weekly report, and this has been basically our archive, but as you'll see, we've changed it. When you hit recent videos, you're going to simply get a different look. It's going to be about the same in terms of the videos that you can go to. It'll be ordered chronologically, so you'll get 4 dailies, then a weekend. Of course, any kind of chart this or chart this after the show will also come in. If you simply want to view the video, you click that link. It will take you to a color box that will, of course, open that up. And if you want to, of course, go to the entire page, you'll just click the title, and that will take you to the title page. But in that way, what you can do, of course, is go through and view any particular day that you want, or if you simply want to see what the charts look like on that particular day, it allows you to take a look at one particular chart. Anyways, back to the show, but I did want you to see that new feature that we integrated over the weekend. You know, although we have a quiet marketplace today, a couple things can be inferred from the data that we have and really what we're seeing in the marketplace. Same 240-minute chart, a couple of things pop right out. First of all, resistance. You can see that we've got this double top right here. We've had 2 occasions where the market has come up just shy of 1360 and back down. So in terms of upside, we have been limited. As you can see, this is the first time we've really seen any kind of a double top, because prior to that, if we look at any particular top, the characteristic of that top really, and that's since this breakout, and I'm calling the breakout happening roughly at, call it 58 to 60, but we've had, you can see here, you've got a high, higher high, higher high, higher high. Same thing with the lows. Higher low compared to this low, higher low. And even though we do have this double top here, in other words, we didn't get a higher high, we did get a higher low. So what it appears to be, even with the resistance in this area, is it does appear as though it is attempting to form some sort of base or some sort of platform, some sort of support in this area. And the area I'm talking about is roughly at 1330. Fib numbers give us that, and they also give us 1320 to 1317. Those are different areas of support. I don't expect the market to break down and go that low, but at some point we are going to go into that next wave, and that next wave is going to be down. We do want to be prepared for it. Now, I have simply pulled up our daily chart, and in the daily chart, it's just as evident because you've got this whole series of tops. These have been these highs just below this particular area. Let me try to straighten that line out as much as I can, but I'll call it 58, 57 right in that area. But you can see given days where we've had highs right in this area. So out of the last 1, 2, 3, 4, 5, 6 trading days, 4 of them have hit a ceiling at that top. Then when we look at the bottom, we had some lows that came in roughly at around 28, 27. These are in at around 25. So we are getting, without a question of a doubt, somewhat of a sideways market. Now, think of it this way. Typically, when a market is moving up or down, it does so in a stair-step manner. Let's go ahead and compress this a little bit. And so we have a real distinction from what we've been looking at, because what we were looking at was really a runaway market as the market broke out up above this long-standing resistance line. That would be this. We had that nice plow up, but it absolutely appears as though, at least for the present, we found a little bit of resistance. Now, if we want to, of course, match that resistance, we can see where that comes in to in terms of a technical basis. And we had talked about this area 1360 1329 first, then 1360 as being a potential top in the market, and we are getting some top activity. We have stops in place. Those stops are extremely, extremely tight in the market. They're below 27. And my sense is that if it is going to continue higher, we'll get a little bit of profits out there. But if it does not, of course, and we're in at 33, if it does not, we will look for really that counter move to this particular rally right in here. And the rally is quite sizable when you consider the breadth of the rally. Took us from, 1181 to about 1360. So you've had a pretty sizable move in the marketplace. So at any point that we get some sort of correction, it really shouldn't surprise us. It really shouldn't take us off our game. And most importantly, it really shouldn't pull away from the fact that we've had a basic turnaround and that we did break above this resistance line, and we're a lot more bullish in terms of sentiment right now than we have been in quite some time. Now, traders, when we look at this is a 4-day chart here, and this has our basic Elliott wave count. And as you know from the weekend report, I'm really debating the basic count that we have and whether this is going to be some sort of an ABC in here, or if we've gone into an impulse, because let's assume that the A actually ends here, we get our B, and then we get our C. If in fact it's a counter trend, we will then go back into a 5 count down. We're still in a bear market. However, after reviewing the data, looking at it really from a perspective of standing back, and that's why we took that macro look on the weekend report, we could easily be back into an impulse phase. And the difference, of course, on an impulse phase is that rather than having a set of 3 waves, 2 of them being to the upside, 1 being a corrective, or excuse me, 2 waves to the upside, 1 corrective followed by 5 down, what we would get is 5 waves, 2 corrective, and 3 impulse to the upside, and then we would get our A, B, C. And what makes this to me such a compelling model is that when we look at really the big picture of the marketplace, and I don't know if I'm going to be able to get all the data in. Yeah, I certainly can. But if we take a look at it, really, I go back to about 2002 and we look at the particular move up here, we get a 61% retracement even from this point right in here to here is 61 at 1135. So with that in mind, we could easily be witnessing, let's go ahead and uncompress that. We could easily be witnessing a scenario in which we've had our major rally, 61% retracement, steep, but it is within line, and now we go back into a impulse phase. And so with that in mind, it really changes the dynamics of the different models that we look at. Now, the beautiful thing about it is that whether we're looking at an A, B, C, or it's an impulse 1, 2, 3, they're going to react in very much similar manners. Where we will understand and where we will get technical evidence of one or the other of the 2 models is really the conclusion of that 3rd wave, because what's really going to happen is, let's go ahead and put our parameters in. What's really going to happen is, let's assume we have an A, a B, and a C. Well, you're going to get a corrective wave down, but you're going to get a corrective wave down if it's an ABC that breaks through the bottom of this. That would tell us that we are back into a bear market count. If in fact we get some sort of a retracement that's 38%, even as much as 61, but does not break through there and then begins to move up and breaches this particular high, then that confirms the model that we're in an impulse. So in either case, I am looking for these 3 waves to unfold in the gold market. 1. 2, depending on how it acts after that 3rd wave, we will be able to put some data together that's going to give us a compelling argument for one model or the other, and we will act accordingly. Now, traders, in the same way that we saw 1360 be an area in terms of real resistance, we're getting that same sort of action in silver at about 22. Interesting thing, though, is when we look at particular tops in the market, these correspond, of course, to 1435 to 1365 in gold. You can see that on this last rally, one, we noticed that the market was trading sideways as gold was moving up. Secondly, this particular rally really ceased to have any kind of power in it, far below the top that should have been particular resistance. I find that interesting. The other thing is that we have had this market under pressure. Our stops below 2090, market's trading roughly 2079, low 55, that's right here. Depending on how far below you have it, you could either still be in this play or not. Effectively, I am not comfortable, or as comfortable, I should say, in silver right now as I am in gold. I think that gold has the likelihood, because it's a safe haven metal, it's the safe haven metal. So if any activity in terms of geopolitical action should reignite, whether it's the Ukraine or somewhere else, that's where we're going to see it in gold, not necessarily silver. But we do have silver under pressure, roughly trading at 2080. This has been Gary Wagner, wishing you as always good trading. Talk to you tomorrow for another daily update and review. Bye-bye.